Yes, good morning. Listen, first of all, the scene setter was excellent, and you mentioned all the important points. I think to your question, it's interesting because the Bank of England is already one of the most optimistic out there, right? When you look at their forecast, it is on the higher end of the consensus range, and if it increases even a bit more, if it upgrades its forecast, sorry, it runs the risk, of sounding excessively hawkish and possibly calling for early hikes. So there are limits here of how much it can upgrade its forecast. Now, a hint, on how it could deal with a better Q1, as you pointed out, is just as the OBR, the fiscal watchdog, did when it assessed the impact of the budget, meaning that yes, there is short-term strength, both in the resilience and in the early signs of the recovery, but it doesn't mean that the entire GDP profile is lifted up. It just means that, the kind of dip we're going through in Q4, Q1 is a bit more shallow, and then the recovery out of it will be a bit less powerful, right? So the real thing to watch out, I think, for today is the estimate of output gap and the estimate of economic scarring that the Bank of England will produce. And likelihood is, in my view, that might not come in on change, right? That might still be the same. So if it changes, to your point, then we might be into quite a lot of discussions about early hikes or further tapering or these kind of discussions. But I would think it's way too early at this point.
A really good point there, because obviously the other thing that we haven't been talking about, but which is the main focus of the Bank of England, is their inflation forecast, and they pretty have the inflation forecast at around 2% on their forecast horizon. So any changes there obviously will be a reflection of the output gap. But then the alternative view is, some analysts have extremely high GDP forecast penciled in for 2021, and some people are saying, well, there's actually now a risk of the UK economy overheating because the Bank of England are still being so accommodative, because interest rates are at record low, because they continue to do QE on a month-to-month basis. What would you say to people who are concerned about the UK being at a risk of overheating at this point, particularly as well when you think about the accumulated household savings that are sitting on the sidelines also waiting to be spent?
Yeah, listen, I think we're a long way away from overheating. The fact that the pandemic might lead to economic scarring is a consensus view. It's not, me being pessimistic here, but, whether it's 1%, 2%, 3%, or whatever, that depends on how optimistic you are on the recovery. But fact is that most of the forecasts out there, even the strongest for this year, have an amount of economic scarring, meaning that, our current forecasts are still below the forecast we did just before the pandemic. The starting point is something like 8-9% below Q4 19 levels. So the fact that the recovery is really powerful is not enough to say that the economy is overheating. You need to bounce something like 10%, 12% to even come close to what we were forecasting before. Remember as well that, labor market, we still have 4 million people in furlough. 4 million, that's 12.5% of the workforce. So while we might cheer that unemployment is only 5%, if you add on top of that all the people out of work, you reach something like 15-20% of people out of work. So what I'm describing here is a situation where the recovery needs to be powerful because the starting point is very low, right? So when it comes to discussing about overheating, we need to, first of all, recover, then come close to normal, and then exceed normal. And to be honest, when we're looking at fast data, our credit card usage, for instance, or these elements, what we can say is that, yes, the recovery is happening, but the recovery is not happening in a way that leads to an overheating yet of all those sectors who are already open, right? We're still a fair amount away from anything that looks red hot, right? When it comes to excess savings, the magic number of 180 billion or 10% of GDP, we are on the more cautious side because we highlight that this saving, has been accumulated because households couldn't spend on entertainment, travel, and hospitalities. And those are sectors where it's difficult to pent up demand. I mean, there's only so many restaurants you can go to per week, and there are only so many travels you can do, once you reopen. So structurally, there's not much pent-up demand in those specific sectors, and we already substituted away from services and into goods. So that movement already happened last year.
Right.
And finally, most of the saving is held by households who are on the wealthy side of things, and usually their propensity to spend is fairly low. So I would be cautious on savings.